Hey there everybody, I just want to show you what I'm up to today in the small account challenge and over in the larger account. We can get into that as well, but I mainly wanted to update you on the small account because I know it's been a few days since we've talked about this. You can see right now I've got all 5 of my positions up, and you might notice a new one there. Can you jump in the comments below, let me know what you notice? What's the new position we got on today? I'm going to show you the position, I'm going to show you exactly why I liked it, and then I'm going to show you how I picked out the strikes to put this trade together and what type of trade this was, what type of options trade. So let's go ahead and take a peek. Target, that is the new position, and I'm just going to bring it up on the chart here. And you can see that Target has been crazy. Target has just gone nuts. And I've been watching it for a while now, and it's always had my interest. I find it fascinating that it keeps putting in these sort of cloud-like pops. It pops and rides the cloud. Do you think it's going to come down? Pops, rides the cloud. And it's been doing this over and over and over, popped again and rode. So every time earnings comes out, Target seems to pop and go. So I was watching it today, and what I wanted to see in this was just some sort of pullback. And some of you know that what I like to do is I like to use the MACD to assign a little bit of pullback value to what's happening. So if you look down here on the MACD, you can see that we got this pull down to the downside. And if you guys don't know what the MACD is or how it works, I'll put a link in the description below to an Investopedia article about the MACD. That way you can kind of see what it is and how it's used. But if we look at Target, you can see that it had the big push up right here where my cursor is. Big push up, and then it retreated back down to the mean, reverted back to that MACD mean, and then it's been doing a whole lot of nothing through here. And then after that, we started to kind of sell off a little. And Target just doesn't sell off all that often. You can see over here, it sold off and then it popped. And then up here, it kind of sold off a little bit in here and then popped. And so what I wanted to do was wait for it to get down here, and then if it ever did that, look at its IV rank and see if it presents an opportunity. So my strategy and setup is very simple. I wait for that MACD to go to the downside, to go negative. After it's been down there and it looks like it's starting to level out a little bit, I look up here at the IV rank. Anything above 30 is fair game. Right now IV rank is 40, and all IV rank is implied volatility measured against itself. So if implied volatility is 25 and 25 is the highest it's been in the last year, then the IV rank would be 100% on that. It's just tracking where it's been over the past 12 months. So right now, Target is 40% to its 100%, or it's filled 40% of its range right now. It's been 60% higher than it is right now, and it's been 40% lower. But anything above 30 is typically pretty good for having some IV that's swollen, and then when you put on an options contract, you want that implied volatility to contract because that's how you make money. Higher volatility, more premium. Lower volatility means less premium, and if you have less premium or smaller dollar amounts in the premium, it's easier to buy those options back and close the position for a profit. So you get $2 up front, then when IV shrinks from that $2, maybe you just pay $1 to buy it back and you net $1. That's kind of the idea or the game here. So we got this pullback in here. MACD dipped down. I liked that. We saw an IV rank of 40. So we came over to the trade tab and we looked through here. I wanted to avoid a binary event. So I decided not to go February 21st. I decided not to go beyond February 21st. March 3rd, that's earnings. I didn't want to get involved in that because binary events can skew your expected move on a stock for the options chain. So I wanted to get out right before that. So I was looking through here, and I like some of these weeklies because I have some additional strikes. So if I open this up, you can see we can do $1 wide strikes in here. Whereas if you go with the monthly, you're forced to go by 5s. And there are pluses and minuses to this, to going with monthlies, and there are pluses and minuses to going with weeklies on the options chain. But I chose to go with February 14th, about 37 days out, and I looked in here. And I decided to go ahead and put on a put spread. Now you can see right here under the strategy meter, if I open this up, Tastyworks does a really nice job of just putting together all of their available strategies, and then you can tweak them however you like. So today, the put vertical, I was short the put vertical, just meaning I sold the put vertical. But if I wanted, I could make it long, meaning buy it, or I could change it to a call. I could sell a call, sell a put. It's really easy to configure and then hit go, and it'll put it up here for you. But you can see I went ahead, I sold the 120 put, and I bought the 115 put. So I got more credit for selling the 120, and I paid a little bit to buy the 115 put for downside protection. And then basically I kept the white meat in between. The difference between the two is what I took in credit today, which ended up being $1.09. So one contract, 100 shares at $1.09 per share, gave me $109 per contract. So in this account, I went ahead and just put on one contract. You can see right here, 1 and 1. So just one contract, so $109 added to the account. And if I open up the balance here on the account, you can see we're at $36.78. And I just want to really quick grab my calculator. I'm just going to do the quick calculation on this. So we've made $678.94 cash that's in the account right now since we started this. And I'm going to divide it by the starting balance, which is $3,000. So right now, multiply that by 100, we're looking at about 22.6% gain on this account in not so many weeks. It's been a very quick rise. And the reason for this cash amount being a little larger, one argument is, well, that's not the actual cash amount, because what if we close this and have to pay 50 cents or 60 cents? We'll deduct that. We'll have to pay a little bit to close. But right now, at this point in time, with all the premium that we've collected on all of these positions, you can see that our cash is $3,678.94. So we're making progress, and I really think this is a great position to have on. Then looking through our other positions in here, you can see I'm in the money on 3 of them. And what's interesting is FedEx has been pushing up. It's challenging my call side on this iron condor. So I'm going to keep a close eye on that and see what happens over the next few days. Obviously, I'd like to see FedEx pull back a little bit and retreat. If I come over here and look at it, you can see it's had quite a few green days in a row. 1, 2, 3, 4, 5, and 6. So 6 green days in a row. My hope is that we catch a little overhead resistance here and we then kind of pull back a little bit. But we'll see where we settle out on this one. If I go to my positions, I can see my expiration is January 31st. I have 23 days until expiration. So what that means for me is that in 2 days, I'm going to make an adjustment to this position. I'm going to collect a little more premium on it. And how I'm going to do that is I'm going to take the put side, the 147 by 142, this put spread, I'm going to adjust it and actually move it up. And I'll collect a credit for moving it. And that credit helps give me more downside protection in case this doesn't work. So if I end up losing to one side or the other, I will lose less because I've been collecting credits over time. And ideally, I just want this thing to settle out and expire between the 147 and the 155. Now, I'm probably going to bring this up to 150 and 145, so it'll be a $5 wide window that I need to hit. But we'll just kind of see how this thing plays out. You can see right now the position is down 38%. And that oscillates throughout the day depending on price action between my 2 strikes, because you've got a put spread below and a call spread above. So it's a little complicated on when it's up and when it's down. But right now, up down 38% on that one. Then looking at Roku here, you can see Roku is a put spread 125 by 120. And I just want to show you guys this one real quick. And this is actually a working order. I'm going to go ahead and cancel this. Roku is up about 18% right now on this position, but they just had news coming out about TiVo joining the streaming world, so it took a little bit of a hit. I almost had the opportunity to close it yesterday, but it pulled back. It didn't quite get to my 55% target. So now it pulled back, so I'm kind of waiting this out to see what's going to happen. 23 days to expiration. Chances are I'm probably going to roll this one ahead a few weeks, collect a credit, and then quietly wait for it to move on. So, but I'll show you how I do that when I choose to do it in a couple days. UNG is sort of a painful one. It just doesn't want to climb back up. It's had kind of a rough go here. I know we had a little green day here, but I really want to see this thing swing at least back up into even just to 1750 would be amazing. That would really help this position out because I have a put spread on that I sold, and in order to close it, I need price action to move to the upside. So right now, the way we stand with 2 days until I choose to roll this thing or close it out on 21 days to expiration is ideal. I'm up 8.8% on it, so if we get to that 21 days and I'm up, over 10%, maybe I'll just close it and we'll have to wait and see. I could also just go ahead and roll it and collect a credit and then hold longer and see what happens. So I'll keep you informed on that one. And then with X, United States Steel, this is another iron condor similar to FedEx. And what I'm looking at right now is down 36%. These condors are tough because no matter which way the price goes, you're likely going to be down money because no matter what direction you travel, you're moving into one of the strikes. You're looking to violate one of the spreads that you have on. So right now, it's at $11.10 and $11.50 is the strike that it's breached. So I would love to see it creep back up and get back above $11.50 and hang tight there because I would see a 50% gain would be perfect for closing this one out and moving on. This is a small position. I just have 2 contracts on, and again, it's only trading at $11.10, so not the biggest position in the world, but it's been an interesting position nonetheless. That chart is looking like, we've hit this bottom multiple times, and now we're back again. So I'm hoping we can get a push back to the upside, and it'll give me an opportunity to close that. So basically, that's the small account challenge update. That's what I've been up to today. If you guys have questions about what I'm doing or what my strategy is for finding these stocks, just looking for that IV rank. And wow, and look at CGC's IV rank, 70.2. That's actually looking really, really good. I look for IV rank, and then beyond IV rank, I'm looking for that MACD to be negative because I don't want to put on a position like a put spread or a naked put when a stock is up, because if you do that, the chances are the stock's going to pull back a little bit. So you're immediately putting that options position in the red. You're negative and waiting it out. Whereas if you wait for the pullback, put on the options contract, sometimes you get a nice curl and a little push to the upside, and it's just enough to get you to 50% so you can close the position out for cheaper than what you bought it for. So I like to let that MACD kind of dictate a little bit of where I enter on the position. So if you have questions, drop them below. Hope you guys were green. Check out our Facebook group. Have a great night. See you tomorrow.